A protractor is a semi-circle shaped instrument that is used to measure angles. If you've used one before, then you would have observed how even a small mistake in measurement could lead to some costly errors. For instance, if you're off course by just 1 degree, then after 1 foot, you would have missed your target by half a centimeter. If the same 1 degree mistake is seen after 100 yards, then you would be off by 1.6 meters. After a mile, the deviation will be a more visible 28 meters. And if we draw a line all the way from the equator to the North Pole, which is a distance of over 6,300 kilometers, that 1 degree deviation would have put us off course by over 100 kilometers. Now, planning and implementing one's financial goals is a lot like this. We know our destination in most cases. We broadly know how to get there, but the path we take is never a straight line. We almost always deviate from the plan, and in most cases, we really don't know when, where, and how much is that deviation. And it is in this setting that we shall go deeper into an understanding of the recently introduced portfolio health feature on the ET Money app. In this video, we shall examine what is portfolio health, how does this feature work, what parts of the portfolio does it track, and more importantly, how can investors take maximum advantage of this feature? Let's begin. At some point in your careers, you might or probably will come across a superior who's a hard taskmaster. Someone who keeps track of what you're doing, someone with big expectations, and definitely someone who has this habit of pointing out mistakes. In that context, ET Money's portfolio health feature can be looked at as your investing taskmaster, but in a good way. After all, this feature keeps track of your portfolio, compares your performance with a top performing model portfolio, and it does not shy away from pointing out any weaknesses and flaws that might be there. The reason we put our energies in finding mistakes is because our experience of working with lakhs of portfolio shows that it's the avoidance of investing mistakes that has the highest bearing on returns as compared to any other factor. In other words, making less mistakes results in a higher return for the investors. And investors do make a lot of mistakes. They make mistakes with their asset allocation, portfolio composition, sector allocation, etc., which all adds up and pulls down the investors' returns. So while avoiding mistakes is an uncommon and underappreciated way of improving, our team at ET Money believes that it is one of the most efficient ways of getting the desired results. The basic starting block for ET Money's portfolio health feature is an understanding of the investor's personality. When we use the word personality, we are looking to extract different types of information from the available data. For instance, we look at scenarios such as how the investor reacts to certain events. Does he invest more when the markets are down? When does the investor typically redeem his or her mutual fund units? And what proportion of his portfolio is equity at different points of time. This last point, that is the level of equity allocation in one's portfolio, is an important part of our modeling, so let's understand this better. Now, say your portfolio presently has an equity allocation of 58%. Now, 58% in isolation can mean anything. It can mean that you are a balanced investor, or it can also be that you are an aggressive investor or a very aggressive investor. To find meaning to this 58% or any percentage of equity allocation that an investor might have, our data sciences team went about the task of creating different model portfolios for different risk profiles. For example, our modeling might at this moment reveal that a conservative investor should have an 8% allocation to equities. Likewise, it might allocate 28% to a balanced investor, 55% to an aggressive one, and let's say 70% in equities to a very aggressive investor. Now, these percentages here are not static, and that's because investors are not static. People continue to make tweaks in their portfolio, and in the same manner, ET Money's model portfolios are continuously adapting themselves to moving factors like valuations, price trends, interest rates, and inflation. Alright, so we have assumed a 58% allocation to equities, which per our table would label you as an aggressive investor. And therefore, all comparisons will be done with ET Money's growth portfolio, which is our version of an aggressive portfolio. So what portfolio health does as a starting step is to establish your current risk profile and find a corresponding portfolio within the ET Money stable so that we can now do a proper apples to apples comparison. This exercise will be the entire basis behind understanding the weaknesses and flaws in your portfolio as we look at a number of important parameters like performance, asset allocation, credit risk, portfolio overlap, etc. Hi, we've just launched ET Money Genius and I'm sure everyone has a lot of questions on it. So next week, join me as I put together everything one needs to know about Genius in a video. What it is, how does Genius help you, the different portfolios of mutual funds and stocks, how have they performed, what are the charges, etc. You'll learn quite a bit in the process and hopefully you'll want to be a Genius member by the time we are done. So do subscribe to our channel and tap the bell icon for an alert on when we release that video. See you there. The first hurdle for any investor is to beat the benchmark. But the real question is, which benchmark? You see, we all invest in multiple funds, large caps, mid caps, international, debt funds, etc. But to find a benchmark that operates in an investing style or asset allocation that is similar to yours is next to impossible. Now, Portfolio Health solves for this by pinning your portfolio against a comparable model portfolio, which now serves as an effective benchmark. Since it's performance that is being measured, we start by computing the X-IRR of the investor's portfolio over its complete duration, which is then compared with the corresponding model portfolio. When presenting this information, our system very smartly mimics the investor's transactions using identical dates and transaction amounts so that a proper apples-to-apples comparison can be effected. Further, the system we have created is also highly flexible in the way that it continuously moves in and out of different model portfolios so that it can accurately replicate the investor's risk tolerance and personality. Now, this part might be sounding a little confusing, so let me explain it in a little more detail. Say 2 years back, a user's portfolio had a low allocation to equities. Perhaps this user was just starting out. In that case, the ideal ET Money benchmark portfolio would be the conservative one and all calculations will be done on that basis. So that was 2 years back, and when we checked on this user about a year back, we see that this user has invested a lot more in equities and the equity portion is 60% of the portfolio. In this case, that is when equity is at 60%, the ideal model portfolio would have changed from conservative to a balanced portfolio or even an aggressive portfolio as per our logic. Now, once our system identifies this, from that point on, it does the next set of calculations for the new status, which in our case is either balanced or aggressive. The point I'm trying to make here is that portfolio health measures performance on a like-to-like basis. So when the investor is operating in a conservative manner, we measure the performance against our conservative portfolio. And when the investor goes aggressive, we too change up and go down the aggressive path. While this is pretty logical, it is also a very complicated exercise. We are dynamically finding the closest model portfolio, we are accurately generating returns for the portfolio and the benchmark, and we are doing all this with the investor moving in and out of different asset classes. And that's why we believe that the benchmarking we do under the portfolio health feature is perhaps the most appropriate tool for any investor to use when comparing portfolios. The ET Money app does a wonderful job of splitting and dicing a portfolio. One can view their portfolio by assets, that is equity and debt. Within equities, you can get to know how much is in large, mid and small cap. Debt instruments are categorized by the credit rating, equity holdings are broken down by sectors and so on. Now, while all of this is important to know, our portfolio health feature not only consumes this information but also makes it a lot more actionable. For instance, let's examine the broader asset classes, equity, debt, gold. Until now, our app would have said something like 60% of your portfolio is in equities, 30% is in debt, and 10% is in gold. But what Portfolio Health does in addition to this is to also tell you what would be the corresponding asset allocation in the model portfolio. In other words, here's how your aggressive portfolio is allocated, and here's how ET Money's model portfolio for aggressive investors is allocated. This allows for a very thoughtful understanding of one's own portfolio and can pave the way for identifying and rectifying its gaps and weaknesses. Of course, please do remember that portfolio health only focuses on the red flags. So if your portfolio is within an acceptable range of a model portfolio, then that's good and therefore no card will be displayed. Now, much like how we compared the primary asset classes, ET Money's portfolio health also brings forth a few secondary but important considerations. For instance, it compares the proportion of large, mid and small caps in the investor and model portfolio. And additionally, it also checks for sector and geographical exposure, which can then be used by investors to make necessary tweaks in their asset allocation. When it comes to the debt side of mutual fund investing, there are two kinds of risk that often concern an investor. There is credit risk, which can bring about big drops in NAV, and then there is interest rate risk, which can lead to subpar performance. Let's start with credit risk, and the idea here is to understand the quality of instruments in one's debt fund portfolio. To explain this, our portfolio health tool pulls up the credit rating of every debt instrument in your portfolio and classifies them as per the investment grade. So if the investor's debt portfolio has mostly high credit rated papers, then it signifies a low chance of default. Likewise, if a majority of instruments have a low rating, then there is potentially a higher risk of credit default, which is something that a portfolio health tool will alert you on. The second risk that the system looks out for is the interest rate risk. Now, the price of bonds have an inverse relationship to the interest rates. So when the interest rate rise, the value of the bonds fall, which subsequently leads to losses in the debt portfolio. The portfolio health tool gives investors an estimate of by how much their debt portfolio might fall if the interest rates were to increase by 1%. This interest sensitivity is estimated by calculating the portfolio's weighted average modified duration, and in case it comes out on the higher side, then the investor can remedy it by reducing their long duration debt holdings. Now, beyond an understanding of returns, asset allocation and risk metrics, portfolio health also helps investors understand the level of overlap in their mutual fund schemes. This is certainly a very popular request from investors, and the idea here is to identify those schemes which seem to be doing the same job, that is, funds which have a similar stock selection and asset allocation strategy. Portfolio health identifies these anomalies so that an investor can plan and execute his or her investment strategies in a better way. It was Mahatma Gandhi who said, "A correct diagnosis is 3/4 the remedy," and that's what ET Money's portfolio health feature is. It's a sort of an investment diagnostic tool that takes your reading, does a thorough examination, matches your reports to what a healthy portfolio should have, and also suggests some medicines, some actions that the investor might want to take. In this video, we understood the inner workings of portfolio health and how it examines the portfolio returns, allocation across multiple assets, sector and geographical exposure, credit risk, interest rate risk, portfolio overlap, etc. And we also learned how these portfolio characteristics are compared to a model portfolio, which is in line to the investor's risk tolerance and investing style. Net, a lot of thought has gone into developing this feature for investors, so do try it out, and if you have any suggestions, feedback, or even appreciation, then do let us know in the comments box below. And with this, we come to the end of this video. If you like what you saw, then do share this video on your social media properties so that it reaches more of your friends and connections. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.